Imagine a world where trade wars are raging and economic tensions are at an all-time high. This was the reality during President Trump's second term as his administration initiated a series of aggressive tariff measures that sent shockwaves across the globe. It all began on February 4, 2025, when President Trump signed executive orders imposing draconian tariffs on imports from Mexico and Canada, along with an additional tariff on Chinese goods. These moves, intended to rectify trade imbalances and address national security concerns, sparked immediate backlash from affected trade partners. Less than 2 weeks later, on February 13, the administration unveiled the Fairness and Reciprocity Plan, a framework designed to counter unfair trade practices by countries like Brazil, India, and the European Union. The plan highlighted disparities in existing tariff structures and trade barriers, positioning the U.S. as a champion of fair trade. Tensions escalated further on February 27 when President Trump announced an additional 10% tariff on all Chinese imports, citing China's failure to curb the flow of fentanyl into the U.S. This measure was set to take effect on March 4, further amplifying the prospect of a global trade war. This decisive move marked a new chapter in the trade confrontation between the two powers. The following day, the administration demonstrated the firmness of the protectionist course, talking about the possibility of introducing new tariffs against the European Union and a number of other key trading partners. Amid growing anxiety in the business community and among America's economic experts, on March 3, the White House made an unexpected maneuver. A presidential decree suspended some of the newly introduced tariffs on certain goods from Mexico and Canada. This move was seen as an attempt to reassure markets and mitigate the looming domestic economic consequences. However, on March 4, the 10% tariff on Chinese goods went into effect, prompting an immediate response from Beijing, which imposed duties of up to 15% on American agricultural products. The escalation of tensions put American farmers and exporters in an extremely vulnerable position. The economic consequences were not long in coming. The beginning of March was marked by a noticeable decline in the American stock market. The Dow Jones Industrial Average lost more than 300 points in just 2 days. This dynamic reflected growing investor anxiety over the current administration's contradictory trade policies and increasing uncertainty in global markets. Despite the economic turbulence, President Trump demonstrated an unwavering commitment to his chosen tariff strategy. On March 8, there was an announcement about the possibility of introducing retaliatory measures against Canadian dairy products and lumber. The reason for this, according to the American leader, was unfair trade practices and high tariffs applied by Canada to exports from the United States. This move only added fuel to the already tense relations between the two neighboring countries. The chaotic and often contradictory tariff policy of the Trump administration created an atmosphere of instability, causing frustration in business circles among investors and international trade partners. The repeated introductions, suspensions, and reimpositions of tariffs led to increased market volatility, exacerbated the trade conflict with China, and increased domestic criticism of the president's economic policies. Ultimately, this policy played a decisive role in shaping the political landscape and influenced the overall economic trajectory of his second term. The exchange rate of the U.S. dollar fell sharply and alarmingly, which many analysts directly attribute to the inconsistent tariff maneuvers of the Trump administration. Confusing policy shifts, sudden announcements, and unexpected cancellations shook global markets, causing investors to dump dollar assets. Instead of fulfilling its traditional role as a safe haven, the dollar collapsed under the weight of trade tensions created by the administration's actions. This report examines the accelerated depreciation of the dollar and its implications for stocks, commodities, and overall investor sentiment. It also explores how tariffs imposed against U.S. allies and trading partners undermined economic stability and served as a catalyst for the dollar's decline. Finally, expert opinions and possible policy adjustments are discussed to highlight what is needed to restore confidence in the currency. Amid growing concerns about President Trump's trade policies bordering on open war, the U.S. dollar is experiencing a period of significant instability, falling to its lowest levels in recent months. The dollar index, which reflects the dollar's value against a basket of key world currencies, has lost about 5% from its peak values recorded in early January, with most of this decline occurring in recent weeks. Previously supported by robust economic data and expectations of a moderate Federal Reserve policy, the dollar has faced significant headwinds. Concerns that the imposed tariffs could slow the growth of the U.S. economy are putting pressure on the currency. At the same time, the euro is showing a notable increase, rising by about 3% in just a few days and reaching $1.70. Dissatisfaction with the U.S. trade strategy combined with improved economic prospects in Europe has led to a revision of investors' positions who were previously optimistic about the dollar. At the end of February, the DXY index recorded a sharp drop, losing more than 1% in a single day. This collapse was triggered by traders who began closing their long dollar positions in response to continued uncertainty regarding trade tariffs. Amid global economic turbulence, emerging market currencies are showing mixed performance against the U.S. dollar. The Canadian dollar and the Mexican peso have proven particularly vulnerable, experiencing a crushing blow after the introduction of new U.S. tariffs. This collapse reflects growing investor concerns about the prospects for North American trade. At the same time, traditional safe haven currencies such as the Japanese yen have strengthened against the dollar as stock markets have been swept by a wave of sell-offs. This phenomenon underscores investors' flight from U.S. assets in search of safer havens. Overall, the weakening dollar is a clear indication of how the trade disputes initiated by the Trump administration, instead of strengthening the power of the United States, have undermined confidence in the country's economic prospects. Analysts note that optimistic forecasts for the dollar have evaporated as the unpredictable tactics of the White House have raised the specter of deeper political turmoil. The S&P 500 experienced one of its most severe one-day declines this year after the administration dashed hopes of easing the tariff regime for Canada and Mexico. Investors fear that the escalation of the trade war could lead to lower corporate profits, disruption of supply chains, and weakening global demand. The turbulence in the financial markets, reflected in the spikes in the VIX index, serves as an unmistakable indicator of how quickly news headlines about trade duties can destabilize stock indices. This chaotic kaleidoscope of statements and counterstatements, characterized by sudden introductions and equally unexpected cancellations of tariffs, only exacerbates the atmosphere of general uncertainty, negatively affecting both U.S. and foreign stocks. In the face of growing market anxiety, there is a noticeable inflow of capital into traditional safe havens such as gold, whose value has reached historic highs. Investors gripped by anxiety are trying to assess the risks associated with the potential escalation of tariff wars and the weakening of the dollar. Although U.S. Treasury bonds initially benefited from this flight to safe haven assets, yields have not fallen as significantly as one might expect. Many market analysts believe that this restraint reflects concerns about stagflation triggered by tariffs, a grim prospect in which rising prices are accompanied by slowing economic growth. The president's inconsistent policy, ironically nicknamed a tariff a week, was particularly evident in the chaos reigning in commodity markets. Oil prices showed unpredictable fluctuations, falling sharply each time tariff disputes threatened global economic activity. Turbulence in global markets reached its peak. WTI and Brent crude benchmarks fell by 3 to 5% in just 1 week, reflecting traders' fears about an impending drop in energy demand. At the same time, individual industrial goods showed a jump in price, caused by the disruption of supplies due to new tariff barriers. However, the overall atmosphere in the market remains tense and wary. The chaotic political environment has stymied manufacturers and shippers around the world, depriving them of the ability to predict further actions by the authorities. According to experts, the most devastating consequence of the tariff policy has been the undermined confidence of the business community and investors. Analysts at leading banks note that until recently, the United States was the center of attraction for global capital. However, amid rising tariffs and uncertainty in the negotiation process, investors are increasingly turning their attention to alternative options. Sociological surveys indicate that companies are postponing decisions on hiring new employees and implementing investment projects because they cannot predict whether a 10% or 25% tariff will apply to certain types of imports in the next quarter. This wait-and-see attitude is putting significant pressure on the pace of economic growth, which inevitably affects the position of the U.S. currency. In an unexpected move that departed from long-standing tradition, the previous U.S. administration imposed punitive tariffs against key allies, causing a wave of turmoil in global markets. Among those targeted were Canada and Mexico, long-standing economic partners linked by the North American Free Trade Agreement, NAFTA, and its updated version, the USMCA. These actions not only triggered an immediate response but also seriously undermined confidence in the stability and predictability of American policy. The introduction of 25% tariffs on imports from Canada and Mexico sparked outrage and concerns about a protracted trade conflict in close proximity to U.S. borders. Despite temporary exemptions offered by the White House, the overall tone remained hostile and provocative. Simultaneously, the doubling of tariffs on Chinese goods from 10% to 20% triggered a new escalation of retaliatory measures, prolonging a dispute that was already putting significant pressure on global economic growth. In late February, threats were made to introduce even broader measures, so-called reciprocal fees, against various countries, including U.S. Asian allies, if they failed to meet vague and undefined requirements. Political shifts and currency turbulence. In addition to general market nervousness, the administration's chaotic policy, characterized by sudden switches, instant suspensions, and tariff reversals, has bewildered businesses seeking to build logistics and forecast costs. This political whip, striking first in one direction and then in another, has earned a reputation as a destabilizing factor, making the dollar particularly vulnerable. Overall, a confrontational course with allies and key trading partners has undermined confidence in American leadership and clouded the prospects for the national currency. Retaliatory tariff measures from partner countries only exacerbate the situation, creating a vicious cycle of escalating tensions that puts pressure on the dollar's exchange rate. Recent data from the U.S. indicate that the manufacturing sector is struggling, reflecting rising raw material costs and supply chain disruptions. The ISM Manufacturing Index in February indicated a slowdown in growth, with some components entering contraction. Many companies directly cite tariffs as a critical issue hindering their development. The Federal Reserve's economic reports, known as the Beige Book, reflect growing concern. Trade uncertainty is becoming a serious obstacle to economic growth. The situation is no less tense on the international stage. The World Bank and the International Monetary Fund express deep concern about how protracted trade disputes could undermine global economic activity. The global economy, already weakened by years of geopolitical instability, faces the direct impact of reduced trade volumes, especially in countries whose economies are critically dependent on exports. The unpredictable policies of the United States create an atmosphere of toxicity for overall investment sentiment. Economists unanimously point to the unpredictability of the Trump administration's trade policy as the most destructive factor. They warn that when tariff rates can jump from 10% to 25% overnight, business is paralyzed. No company is willing to invest significant resources, knowing that the next tweet from the White House could instantly devalue their plans. This atmosphere of heightened uncertainty stifles business expansion, research and development, and hiring, which is a key element of economic viability. Before continuing, it's worth pausing for a moment. If the presented material has sparked interest, a little support would be very welcome. A simple click of the like button will help spread the information to a wider audience. And if any thoughts or considerations arise, they can be left in the comments. But let's get back to the heart of the matter. Tariffs, in essence, are a blow to consumers' wallets as they lead to higher prices for imported goods, from electronics to appliances. The impact of this process on inflation remains somewhat unclear, but ordinary families are already feeling the pinch of rising prices on many goods. This is where a complex situation arises. If economic growth continues to slow while prices steadily rise, the Federal Reserve will face a difficult policy choice. Investors, in turn, are beginning to fear stagflation, that ominous combination of low growth and high inflation that could further weaken the dollar's position. Currently, the dominance of the U.S. currency in global trade is being challenged by the growing trend of de-dollarization. More and more countries are seeking to reduce their dependence on the dollar in international settlements, which could significantly alter the global economic landscape. The world is witnessing an escalating process that is gaining momentum in various parts of the planet. In the past month, several significant events have fueled this trend in the BRICS countries, Latin America, and even some European nations. These changes are driven by geopolitical disagreements, sanctions pressure, and a desire among nations for greater independence in monetary policy. In practical terms, this means that countries are increasingly using alternative currencies in mutual trade, entering into deals that bypass the dollar, and revising the structure of their central bank reserves, reducing the share of the U.S. currency. At the same time, political leaders are openly declaring their support for these steps, despite warnings from experts that the dollar's position is unshakable and cannot be undermined overnight. Essentially, this is about de-dollarization, a process aimed at reducing the dominant role of the dollar in international trade, cross-border payments, and currency reserves. For many years, the dollar has been the world's main reserve currency, but its share in global central bank reserves has been steadily declining, reaching multi-year lows. Many developing countries, especially those in the BRICS group, see reducing dependence on the dollar as a way to protect their economies from the volatility of U.S. monetary policy and the threat of sanctions, which are increasingly being used as a tool of pressure on the international stage. In an era of global turbulence caused by Western sanctions against Russia and rising interest rates in the United States, the de-dollarization of the global economy is gaining momentum. The BRICS countries, comprising Brazil, Russia, India, China, and South Africa, are leading this movement, seeking to reduce dependence on the U.S. dollar in international trade. In late February 2025, key representatives of the BRICS countries met and reaffirmed their commitment to expanding the use of national currencies in trade transactions, a direct response to pressure from the United States. According to the Brazilian Ministry of Foreign Affairs, the bloc is developing an innovative system that will allow member countries to conduct trade settlements in their own currencies without the need to use the dollar. Brazil, in particular, emphasizes that its exports to BRICS countries reached an impressive $120 billion in 2023, significantly exceeding exports to the US and Europe, which amounted to $83 billion. Despite this, a significant portion of trade within BRICS is still conducted in dollars, indicating the enormous potential that could be realized by eliminating obstacles related to payments in the US currency. Brazilian Foreign Minister Mauro Vieira notes that trade relations between BRICS countries have not yet reached their potential, underscoring the need to simplify trade operations not linked to the dollar. These efforts are aimed at creating a more stable and diversified global economic system, less susceptible to fluctuations and political pressure from individual countries or blocs. Contrary to expectations and numerous rumors about the creation of a single BRICS currency, Brazil, which is set to chair the association in 2025, has firmly denied the possibility of its imminent appearance. Brazilian government officials have stressed that the idea of a new reserve currency, put forward by President Lula at previous summits, has not become the subject of serious technical discussions. Instead, the emphasis is on more realistic and practical steps aimed at simplifying international settlements in national currencies. The goal is not to directly replace the US dollar, but to reduce dependence on it. Plans for the BRICS summit in July include the integration of national payment systems and the exploration of the use of advanced financial technologies such as blockchain. This will significantly reduce transaction costs and speed up settlements. For example, there's the Brazilian instant payment platform PAX, which is now more popular in Brazil than cash or credit cards. Its integration with similar systems in other BRICS countries is under consideration, which would allow for fast cross-border transfers in national currencies. Such infrastructure would make trade in BRICS currencies more convenient and efficient. Brazil is demonstrating an innovative approach by managing a payment system in national currencies with its closest neighbors Argentina, Uruguay, and Paraguay. This initiative allows countries to make direct payments through RIS, bypassing the dollar. Although volumes are still small, last year Argentina used this system for approximately 5.1 billion Brazilian reals in trade, less than 10% of its total trade with Brazil of $27.4 billion. Officials express confidence in the potential for growth, linking it to the development of new technologies. Within BRICS, Russia and China are leading the way in phasing out the dollar in mutual trade, especially after the imposition of sanctions in 2022. The Kremlin stated that by the beginning of 2024, over 90% of trade transactions between Russia and China were conducted in national currencies, predominantly in yuan and rubles. In 2023, the Chinese yuan effectively displaced the dollar as the most sought-after foreign currency on the Moscow exchange. Simultaneously, yuan deposits in Russian banks exceeded dollar assets, indicating a strategic reorientation of Moscow's financial system toward the east. Russia has taken decisive steps to reduce its dependence on the Western financial system, converting a significant portion of its sovereign debt from dollars and euros into Chinese yuan. This maneuver led to a tripling of yuan-denominated loans, reaching an impressive $46.1 billion. To strengthen this financial shift, Russian banks are actively connecting to the Chinese cross-border interbank payment system, CIPS, seeing it as an alternative to the SWIFT international payment system. Concurrently, Russia's own SB-FES system is also developing. These interconnections allow Russian and Chinese companies to conduct financial transactions bypassing Western banking infrastructure, thereby protecting transactions from the impact of sanctions targeting dollar-based settlements. As a result of these efforts, there is a significant shift in the structure of Russia's trade settlements. By 2023, the Chinese currency reportedly accounted for up to 20% of Russia's total trade volume, a sharp increase compared to a negligible 1% before the start of the conflict in Ukraine. The expansion of the BRICS bloc and the strengthening of partnerships also play an important role in the de-dollarization process. The inclusion of new members, including major oil exporters such as Saudi Arabia and the United Arab Emirates, is seen by BRICS as strengthening the diplomatic counterweight to Western dominance on the world stage. By expanding its ranks, BRICS unites a substantial 45% of the world's population, a quarter of global trade, and almost a third of global GDP under its banner. Notably, more and more countries are moving away from the dollar in mutual settlements. Saudi Arabia, for example, has begun selling oil to China, pricing it in UAE dirhams and concluding contracts convertible into gold through the Shanghai Exchange. Iran, another new member of the bloc, has agreed with China to receive payment for a major infrastructure project not in dollars but in commodities, including oil. Such agreements clearly demonstrate concrete steps aimed at circumventing the dollar system. Moreover, BRICS countries are actively exploring the use of digital currencies. The Bridge project, initiated by China, Hong Kong, and the UAE, has successfully tested cross-border payments using central bank digital currencies, including China's purchase of oil from the UAE for digital yuan. All these efforts align with the BRICS strategy of de-dollarization and strengthening the position of national currencies to stimulate economic growth. On the political stage, BRICS leaders are demonstrating a determined attitude. At the summit in the fall of 2024, the leaders of China and Russia, Xi Jinping and Vladimir Putin, expressed solid support for the idea of creating a payment system independent of the dollar. Despite the lack of specific details, the Russian side particularly emphasized the inevitability of abandoning the dollar in international settlements, pointing out that the U.S. sanctions policy only fuels this process. As early as 2022, Vladimir Putin spoke of a steady trend of de-dollarization of the Russian economy. However, there is no complete unanimity on this issue within BRICS. India and Brazil are showing caution regarding any initiatives that could be perceived as confrontational or destabilizing. While India uses rupees in some trade operations, it still prefers the dollar for most of its foreign trade settlements and is in no hurry to reduce its dollar reserves. Brazilian President Lula da Silva, advocating for trade in national currencies, emphasized that none of the countries plan to abandon dollar reserves or create any problems. According to the BRICS declaration, the focus is on a gradual, voluntary, and non-binding expansion of the use of national currencies alongside existing international systems. In Latin American countries like Brazil and Argentina, the trend of de-dollarization is gaining momentum. These states are seeking to reduce their dependence on the U.S. currency by implementing alternative methods of settlement and entering into trade agreements that allow them to bypass the dollar. Brazil, as the largest economy in South America, has taken an important step in this direction by concluding an agreement with China to conduct bilateral trade operations in Brazilian reals and Chinese yuan. This agreement, signed in April 2023, provides for the creation of a clearing mechanism in Brazil, allowing companies from both countries to directly carry out trade transactions without resorting to the use of the dollar. China is Brazil's main trading partner, and the annual trade volume between the two countries exceeds $150 billion. By eliminating the need to convert currencies through the dollar, businesses can reduce transaction costs and decrease their vulnerability to exchange rate fluctuations. The shift to trade in yuan reflects China's desire to strengthen the position of its currency on the international stage, especially in relations with strategic partners. On the global stage, voices are increasingly questioning the unconditional leadership of the dollar. Brazilian President Luiz Inácio Lula da Silva openly wonders why countries should be rigidly tied to the U.S. currency, emphasizing their right to seek alternative paths that better suit their economic interests. Argentina, facing serious economic challenges and dwindling dollar reserves, has turned to the Chinese yuan as a tool for trade operations and debt repayment. In 2023, the country announced its transition to paying for Chinese imports in yuan, which reduced pressure on its foreign exchange reserves. Moreover, Argentina activated a currency swap agreement with China, opening access to yuan liquidity of more than $18 billion provided by the People's Bank of China. By mid-2023, the volume of trade operations denominated in yuan exceeded $1 billion, making Argentina one of the largest users of the Chinese currency in Latin America. This move allowed the country to bypass the shortage of US dollars and ensure the smooth import of goods from China. In the Latin American region, states such as Bolivia and Venezuela are also showing interest in using the yuan in trade operations, seeking to reduce their dependence on the US dollar. Some Latin American leaders, including Brazilian President Lula da Silva, have proposed the creation of a single regional currency called SUR, which means South in Spanish. This initiative aims to reduce the South American continent's dependence on the US dollar in mutual trade and investment. Although this proposal is in the early stages of discussion, most trade transactions are still carried out in traditional currencies. At the same time, Brazil is taking steps to expand the system of payments in national currencies within the framework of the Mercosur Agreement, which simplifies direct settlements in the national currencies of the participating countries, bypassing the dollar. While these efforts are still small compared to the total volume of trade, they represent concrete steps towards regional de-dollarization. The European approach to de-dollarization is more restrained compared to the BRICS countries and Latin America. The euro is already one of the main global reserve currencies, and European politicians and entrepreneurs seek to diversify currency operations, moving away from the dollar in certain areas, especially in energy trade and financial operations. In the financial landscape of Europe, a noticeable trend is gaining momentum: the expansion of the use of the euro in international trade operations, which is gradually pushing the dollar into the background in a number of sectors. By 2024, the European currency had already overtaken its American competitor, becoming the dominant currency for invoicing in the European Union's foreign trade. More than 52% of export operations from EU countries were carried out in euros, while the dollar accounted for only 32%. In the field of imports, the dollar still retains its position, providing 50% of EU transactions, which is largely due to trade in energy resources. Nevertheless, the use of the euro in import operations has risen to 41%, indicating a slow but steady shift towards using its own currency. Europe's pursuit of strategic autonomy has spurred it to intensify efforts to transition energy trade to non-dollar settlements. Following the imposition of sanctions by the United States against Iran and Russia, European countries began seeking alternative mechanisms for conducting trade that are not dependent on the dominant dollar-based SWIFT system. In 2019, Germany, France, and the United Kingdom established INSTAX, a special mechanism designed to enable European companies to trade with Iran using the euro and other local currencies instead of dollars. Despite the limited use of INSTAX, this step demonstrated Europe's willingness to create alternatives to financial systems controlled by the United States. With the start of the Russian-Ukrainian conflict in 2022, European gas companies faced an unexpected demand from Moscow to pay for Russian gas supplies in rubles. This episode, although it ended with Europe reducing its dependence on Russian energy, clearly demonstrated the flexibility of the European economy and its ability to adapt to alternative currency settlements. Currently, European companies are showing increasing interest in trading energy resources in yuan. A landmark event was the deal between French Total Energies and Chinese Sinopec in early 2023, the first sale and purchase of liquefied natural gas in history to be settled in Chinese currency. Shortly thereafter, French Engie also concluded a similar agreement with China. These operations demonstrate the growing confidence of European businesses in using non-dollar payments, especially in trade relations with China. In parallel with this, the European Central Bank is increasing its reserves in yuan, joining a small but growing group of European financial institutions seeking to diversify their currency assets. And that brings this video to an end. We thank every viewer who shared this time with us. We sincerely hope that the presented material was useful, interesting, or perhaps even inspiring for you. If you felt a response to our ideas and messages, the best way to express your support would be to like this video and subscribe to the channel. This will not only inspire us to new achievements, but also make you part of our growing community of like-minded people. Your participation is invaluable. And right now, another fascinating video from our channel awaits you on the screen. Don't miss the opportunity to broaden your horizons and learn something new.